Back to the channel. Welcome back to another video. If you're stopping by the channel for the first time, please consider subscribing to my channel. And while you're at it, smash that like button for me. I really would appreciate it. Also, hit that post notification bell so that you're notified every time I upload a new video. Be careful down in the comment section of the videos. A lot of spam, a lot of scammers. I will never ask you to contact me by WhatsApp or Telegram. I also do not invest money for my subscribers, so please be careful. Don't get yourself scammed. Guys, get down in that description box, click on that Instagram link. Richard Fain Millionaire Mentor Instagram page. Doing real well. Thank you so much for all of you guys who have decided to give me a follow on Instagram. We're starting to get that Instagram page up in numbers, which is a good thing. I'm starting to post more content on the Instagram page. So if you want to follow me when I'm not on YouTube, get down to the description box, click on that Instagram link, Richard Fain Millionaire Mentor Instagram link, and get over to Instagram, give me a follow, and then send me a DM to let me know that you're rocking with me, and so I can say thank you. I really appreciate you guys. Over 3,000 of you guys have already, started following me on the new Instagram page. Of course, the old Instagram page, I had over 90,000 followers. But Instagram shut that page down for whatever reason. They never gave me in my opinion, a valid reason for shutting it down. But I'm assuming there was a lot of impersonating scammers over there, and they, I guess that's why they shut it down. They didn't really give me a reason. But the new Instagram page has been up for about 3 months, and it's just plugging right along. I'm starting to promote it a little bit more on the YouTube channel. And as I continue to promote it, obviously there will be people that will go down and click on the Instagram link and decide to give me a follow. And I really appreciate that. Thank you guys so much for rocking with me. It's been crazy 4 years. Here, your fifth year, I'm in the 5th year of being doing this YouTube thing full time, and you guys have been wonderful. So thank you so much for supporting me, rocking with me. I appreciate it. Also, I want you guys to do me a big favor. Go down to the description box, click on the second link, and go check out the Richard Fain Millionaire Mentor website. That's www.richardfain.net. Over 100,000 of you guys have already went and checked out the website. A lot of you guys have decided to make an investment in yourself, and you've purchased some digital products. We got everything from, credit repair, credit restoration, how to increase your credit score, all the way to how to invest in real estate with little or no money down. We got digital products for the mindset. We got one called the Millionaire Mindset, wonderful digital product to walk you through how to change your mindset to a millionaire's mindset, right? And continue to work on your mindset, because that's the key, right? If we're going to build wealth. We also got budgeting product on there, a digital product for those of you who want to be better money managers of your income. It gives you a whole system to follow, makes it easy for you. All you got to do is put the time and effort into it. If you want to invest in the stock market through paper assets, we have 2 wonderful digital products. One is index fund investing, and then the other one is the drip investment method. Both of those are wonderful digital products to help you learn how to invest in the stock market through dollar cost averaging. So listen, if you're interested in making an investment in yourself and getting to your pot of gold at the end of the rainbow, my recommendation is get down to the description box, click on the website link, go check out those digital products and make an investment in yourself today. You are the biggest investment you will ever make in your life is in you. The biggest investment you will ever make in your life is you. Why not start today? Make an investment in you. Get over to the website, check out those digital products. And while you're there, consider joining the mentorship group. We just had our second live stream on a private live stream through the Discord, through the membership group last night. And again, we had a pretty good turnout. The whole purpose is not for us to have 10,000 people in the private live stream. That's not the purpose. The purpose is have the people there who want to be mentored. Have the people there who have a vested interest in getting information that they can then execute on to get to their wealth. That's who I'm looking for. Those are the people that I consider my mentees, right? So if you want to be mentored by me, where we're going to be doing these weekly live streams for at least 90 minutes. I think last night I was on there another 2 hours, just answering questions, right? It's just rapid fire questions, and I'm answering as many as I can in that 90 minutes or 120 minutes. And then for whatever reason, if I miss you, you got access to me 7 days a week, 365 days a year. All you got to do is send me a direct message through the Discord, or you can just simply email me. Hey, Richard, I'm part of the mentorship group. I didn't get my question answered last night in the private live stream. Here's my question. The key is you have access to me. That's the key, right? The live streams are just a bonus. The real key is you have access to somebody who has 30 years of experience buying real estate for income, investing in the stock market through paper assets, building and growing businesses, building and growing side hustles, and getting to where you at some point want to get to. That's the key. That's what you get from a mentor, right? And by being a part of the membership group or the paid mentorship group, you get access to all of that. Like I said, the 90-minute, 120-minute private live streams weekly are fantastic, but that's really not where the rubber meets the road. The rubber really meets the road where you have someone you can email and they respond to you and give you genuine, good, sound advice based on their experiences over 30 years. That's what you're really hanging your hat on, guys. The live stream, the private live stream every week is great, but it doesn't replace you being able to contact me and saying, hey, Richard, I just got into a situation. I need your opinion on it. That's what you get in the mentorship group. You get that access to me. So let's keep that in mind, okay? The third thing, and then we're going to get into the meat and potatoes, is Moomoo, right? Moomoo is my preferred self-directed brokerage app that I'm going to be using over the next 10 years to double my net worth. I'm going to be buying 3 big boy paper assets, 3 big boy blue chip paper assets, and I'm going to be doing them through this Moomoo app. Now, down in the description box is a link for Moomoo. Special offer for you. You're going to get 10 free fractional shares of the Magnificent 7 stocks when you sign up for Moomoo using my link, first link down in the description box, and you put $100 in your new brokerage account, your Moomoo account. Now, you don't pay that $100 to Moomoo, you don't pay it to me, that's your money. It's in your brokerage account. They're going to give you the 10 free fractional shares of the Magnificent 7. Now, you can take that $100 if you want, and you can continue buying fractional shares of the Magnificent 7 to continue to build your wealth. Or you can take that money and start buying fractional shares of ETFs or a whole share of an ETF. You can buy SPLG, it's trading at about $60 a share. So boom, you can buy $100 worth of SPLG, which is the S&P 500 ETF that I purchase. I'll be purchasing some this morning. I meant to do it before I got on this live stream, but I forgot. So once I get off the live stream, I'll be purchasing some SPLG and FTEC today. I purchase it every day the market's open, at least $100 to $300. So that's what you will do when you open your Moomoo account. You're going to start investing. You got to start investing to build wealth. And when we talk about what we're going to be talking about today, you'll understand why you want to invest. There's a great opportunity getting ready to happen because inflation is still skyrocketing. Right? It's an opportunity for people who are trying to build wealth. Let's get ready for this opportunity, but you got to have a brokerage account. You got to have money in the brokerage account. You got to be ready to execute. So if you're ready to execute, you're ready to put money in your brokerage account, get down to the description box, that first link, click on that Moomoo link, open it up today. Don't delay, open it today, get the transfer from your bank into that Moomoo account and be ready to go, because there are some opportunities getting ready to happen, and I'm gonna walk you through what those opportunities are today. So do me that favor, get down in the description box, Moomoo link, hit the website, and then give me a follow on Instagram. Well, all right, guys, let's move on into the main topic of today's live stream video, whatever you want to call it. And that is inflation. We just got a report this morning that shows inflation is still ticking up and it's being sticky. That's not a good sign when it comes to the Federal Reserve feeling comfortable enough with where inflation is to reduce rates. That doesn't help us. And we're going to walk through the report and I'm going to show you what I mean. Now, this report that came out this morning is not the main report. Well, it is a main report, but you got two reports. Matter of fact, you got three reports. But we're going to talk about the two reports that we're going to focus on today and tomorrow. The report we're going to focus on today is what they call the Producer Price Index. Just think about it as the Business Price Index. Tomorrow, which is Wednesday, we're going to focus on the Consumer Price Index. Both of those reports, they measure how fast goods and services are going up in price. One of them for the consumers, one of them for businesses, right? Businesses got to buy stuff too, right? So they're not a consumer, but technically they're a business consumer because they're buying stuff too, just like you and I are buying stuff through the Consumer Price Index. Gives us an idea of what the increase in our goods and services have been month over month, year over year. We do the same thing for businesses, right? We do the same thing for businesses. So that report came in this morning, and let's go through it. Let's go through it. Some of y'all might be, well, golly, Richard, why is that important? Well, it's important because think about it this way. The goods and services you and I buy, we got to buy them from a business, right? Now, if their cost to buy their raw material, whatever they got to buy in order to pass on to us as products and services, if their costs go up, who do you think they pass that cost on to? We'll pass it on to you and me. If my grocery store has to pay more for eggs from the farmer or wherever they get them from, if they got to pay more, okay, we're not going to charge Richard more. We'll absorb that cost. Our cost for eggs will increase, but we won't pass it on to Richard. No, they're going to pass that cost on to me through consumer pricing going up. So if businesses got to pay more for the things they sell us, guess what those businesses are going to turn around and do? They're going to charge us more. Ain't no business going to just absorb all of that on their own. So that's why this report is important. Because if businesses are getting charged more for the things they sell us, guess who they're going to pass those costs on to? Us. Us. So this report, the PPI report, is important because it gives us an idea of what the cost businesses are having to pay for these goods and services, right? So let's go. Here's the headline. Wholesale prices rose 0.5% in April, more than expected. Basically, hotter than expected. So you got these experts out here that say it shouldn't go up more than this. It beat that. It went up higher. That's not good. Is that a precursor to tomorrow? I think it is. I think it's a precursor. I think if PPI, right? If PPI is on the rise, then I believe CPI will be on the rise. That's just my opinion. It may not happen that way, but this is my opinion. So here we go. Wholesale prices. Remember, we're talking about businesses today. Tomorrow we'll talk about consumers when that report comes out. But this business report is, I told y'all, equally as important. Because if businesses got to pay more for this stuff, they call it wholesale, right? When businesses buy something, it's wholesale. When they sell it to us, it's retail. So that's why they're calling it wholesale. Wholesale, businesses buy wholesale, consumers buy retail. Tomorrow's report will be retail, today's wholesale. Just want to make sure we clarify so no one gets confused. Oh, golly, that's not the CPI report. Well, it's more than one. Just pump your brakes. Hold up. It's more than one report, okay? So the wholesale prices jumped more than expected in April, putting up another potential roadblock to interest rate cuts anytime soon. Here we go. That's why I'm telling y'all, inflation skyrocketing. And I'm gonna connect the dots. How inflation skyrocketing will affect stocks, crypto, real estate. Just bear with me. We'll connect the dots. The producer price index, right? Basically the business, right? Price index. That's the way I like to look at it. They call it the producer, but I like to call it the business price index. Makes it easier for me to put those two together. Business price index, consumer price index. This producer thing throws me off a little bit, but let's call it its technical name. The producer price index, a gauge of prices received at the wholesale level, increased 0.5% for the month. So month over month, it increased from March to April, increased by 0.5%, higher than the 0.3% Dow Jones estimate. That's your experts. So your experts thought it would increase 0.3% month over month, but it beat that expectation and went up to 0.5. That's why I told you inflation is on the rise, right? That's month over month. The Labor Department's Bureau of Labor Statistics reported Tuesday. However, the March reading was revised from an initial reported 0.2 to a decline of 0.1. So they did some revisions for the March month over month, right? Stripping out volatile food and energy prices, the core PPI also rose 0.5 compared to 0.2. So you got two measures. You got what they call headline, which includes food and energy costs. It's everything. Headline is everything. Every good and service. That's headline. We missed on headline. Came in at 0.5. We needed it to come in at 0.3. Missed it. Then if you strip out energy and food because it's volatile, the price changes on that so much, so rapidly, it's volatile. If you pull that out, they call that core. We missed on core as well. Core went up 0.5. We needed it at 0.2. Excluding trade services from that core group showed 0.4 increase on the month. 3.1 on a 12-month basis, the highest level since 2023, since April 2023. So the highest level in a year. That's why I'm telling you, tick, 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 tick. Not amazing, not drastic, but tick, tick. See, any little tick, tick up, guys, I don't care if it's 0.1%. Any tick up is not good for the case we're trying to make for the Fed to reduce rates. Anytime you get upticks, that's still an increase. I don't care how small. It's still an increase. Why would the Fed reduce rates if inflation is still going up? They wouldn't. They may turn around and increase rates. That's what they might do. So it's important us to understand, no matter how small or how incremental, any increase is not good, especially when your mandate is to have it 2%. 3.1% is not 2%. Why would the Fed reduce rates? They wouldn't. So that's why this is an important thing for us to understand. On a year-over-year basis, the wholesale inflation rose 2.2%, also the highest in a year. The core PPI inflation was at 2.4%, the biggest annual move since August 2023. Both numbers were in line with estimates from Reuters. Just showing you big jumps, the biggest it's ever been in a year, the biggest it's ever been in a year. Core, headline, the biggest it's been. I'm just saying, guys, I don't know. Again, I don't know if this is a precursor for what we're going to get tomorrow in the CPI, but the PPI today is not good. It's not good. Stock market futures were around break even following the data, while treasury yields were mixed. So what does that tell you? The market is sort of like, is that good? Is that bad? Because see, you didn't see any, you didn't see a whole lot of activity of investors fleeing the stock market and moving to treasuries. If you would have saw that, you would have saw treasury yields go up. Anytime you see those treasury yields go up after news like that, that means people, elite investors, are taking their money out of the stock market and they're favoring the treasuries, right? And then if you see treasuries go down, that means money is going into the stock market. Those two compete for the same investors, right? But this morning it was mixed. It was mixed. People are like, is that good news, bad news? Anything up, like I said, the smallest uptick is bad news to me. That's my opinion. Sticky inflation looked downright stuck this morning after a much hotter than expected inflation reading. But with last month's numbers revised lower, this report may not have been as much of a upside shock as it first appeared to be. See, they revised the numbers from last month. So a lot of people are thinking, they revised in March, maybe they revised in April, so let's not panic. Let's not panic. They did revise the numbers downward in March, so they may revise April's numbers downward. So it may not be as bad as we think. Let's give it a couple of weeks and see if there are any revisions. That's what people are basically saying, investors, right? Because they saw that happen last month where it was revised down. We came in with this hotter than expected March report, then they revised it down a little bit. So it wasn't as hot, right? So that's what some investors are thinking. Let's just hold on and see what happens over the next week or two. Services prices boosted the wholesale inflation reading, rising 0.6% and accounting for about 3/4 of the headline pain, while the final demand goods index increased 0.4. The services increase was the biggest monthly gain since July of 2023. See, that's the thing that bothers me. You got this biggest gain in a year, and that's services. And y'all know what services are. That's, hospitality, travel, anything that has to do with servicing people. That went up, right? That went up. Portfolio management helped drive the services costs, rising 3.9% on the month. Goods prices, as measured by the PPI, rose 0.4, reversing a 0.2 decline led by 2% increase in the energy index, which included a 5.4 surge in gasoline prices. The final demand index for food fell 0.7. The latest inflation data comes with the Federal Reserve on extended hold regarding interest rates. Policymakers have said in recent days that they expect inflation to trend lower through the year, but need more evidence that it is convincingly on its way back to central bank's 2% goal before cutting rates. Recent data points have not been encouraging. Remember earlier in the month, what did we get? We got the jobs report, which was what? That was encouraging. Why? Because the job market was cooling off. But then all of a sudden, boom, we start getting these other reports, PPI report, CPI report coming tomorrow. We'll see what that says, right? We'll see. But it doesn't bode well for reducing rates if we can't get inflation continue to go down. It'd be one thing if it was coming down. Very small increments, that's okay, but it has to come down instead of going up. Right now, it's going up, right? It's going up. Like I said, ever so slightly, but it's still going up. Similarly, the Fed's preferred measure, the Commerce Department's Personal Consumption Expenditures Index, also has been running hot, showing inflation running just shy of 3%. See, that's the PCE report. That's the main one they hang their hat on. That thing is at 3%. Need to be at 2%. So I keep telling y'all, until the Fed feels confident we can get to 2, they're not going to reduce rates. They're just not going to do it. They're going to keep them higher for longer. and still continue to inflict more financial pain on the middle class. The 1% ain't feeling no pain. The middle class and the lower middle class earners are feeling the pain when rates stay higher for longer. Not the 1%. We talked about that yesterday. They ain't feeling no pain. They're buying assets. Like I told y'all yesterday about these rich people paying cash for these houses. See, they're getting deals on these houses and they're paying cash. There ain't no recession or no inflation or none of that, no interest rate. They don't care about any of that. They see assets at a discount. Well, real estate ain't at a discount. Yes, it is. It's at a discount because I'm not going to pay you full price when nobody else won't pay it to you. So you can ask for whatever you want to ask for and just keep holding your house there and not sell it. I don't care what you're asking for it. Nobody else is offering you to buy it but me. So it's whatever I'm willing to pay you. Now, whether you accept it or not, that's on you. But I don't care if you got the house price for $1 million. It's been at $1 million for 7 months. I'm gonna give you $850, all cash. There you go. That's where you make your deal. I keep telling you guys, that's the way you make your deal. People are taking those deals. All of the various inflation measures are showing price pressures well ahead of the Fed's target. Everyone you look at, PPI, CPI, PCE, all of them, right? All of them. All of them are showing that inflation is sticky or slightly increasing. That's not good. In addition, various consumer surveys have shown expectations running hot. The New York Fed's monthly survey released on Monday showed the one-year inflation outlook at 3.3%. The highest since November, pushed in good part by expectations that housing-related costs will continue to increase. And when they talk about this survey, that's where the Fed goes out and surveys people. And people believe inflation is going to be higher for longer, 3.3%. And they believe the housing costs are going to continue to escalate. And I believe that too. So all I'm telling you guys is that's one report that came out today that is showing us that inflation is still skyrocketing incrementally. Now, why in the world would that hurt stocks? Why in the world would that hurt crypto? Why in the world would it hurt real estate? Well, guys, anytime interest rates are high, assets go low. Why do assets go low when interest rates are high? Because people borrow money to buy assets. And when money is too expensive to borrow, people don't buy assets, or at least not the middle class and the lower middle class. The people that buy assets when interest rates are high are who? People that are trying to get rich. People that are trying to make money. The 1%ers. That's when they buy assets. That's when they really double down on assets when interest rates are high, inflation is high, everybody's on the sidelines scared to death or can't afford it. 1% swoop in and buy everything that they want to buy. That's how they get wealthy. That's how they stay wealthy. So how does that affect me and you? Why is that good for me and you? Because we're in the building stage of wealth. If I'm in the building stage of wealth, I need to buy very good assets at a discount and hold those assets till they trade at a premium again, just like the rich do, just like the 1% do. I told y'all over and over, we have to copy the 1%. Their financial breadcrumbs lead us to wealth. This is what they do. This is how they stay wealthy. This is how they get more wealthier. While we're panicking because interest rates are 7.5% on mortgages, while we're panicking, Fed funds rate is 5.5%. While we're panicking, 7.5%, 8%, 9%, 10%, 12%, 15%, 20% for a car loan, depending upon where our credit is. While we're panicking, the 1% are buying assets at a discount. That's how they get wealthy. The best time to buy assets, especially if they're really good assets, is when they're discounted. If the Fed keep interest rates, not if, they're going to keep interest rates higher for longer, it's going to force assets down in value. They go down in value because there's less demand for them. There's more supply of assets, but less demand to buy them. Drives prices down. When there's more demand to buy assets and there's fewer assets, prices go up because there's more demand. Right now, there is little to no demand, especially in the housing market. Especially in the housing market. So if you're a person that has the wherewithal, you can afford the 7.5% mortgage rate, you got cash, what a perfect opportunity for you to go buy discounted real estate. Very good real estate at a discounted price. That's how you do it. That's how the 1% does it, right? Same with paper assets. Now, paper assets did not go down sharply today because of what? Investors are saying, hey, this report might be revised. Let's not throw the baby out with the bathwater. Let's wait till tomorrow. CPI will be out. Let's see what happens with CPI. So you didn't see the stock market really sell off, sell up, nothing. It just kind of, you didn't see US treasuries explode upward. You didn't see them fall downward. They just kind of, because people are waiting to see. But one thing I will guarantee you, if that CPI report tomorrow comes out and it looks like this PPI report, there'll be some sell-off tomorrow. There'll be some opportunity to grab these assets at a discount. Again, I'm buying every day. I get this often. I get this question often. Well, Richard, what are you doing? How are you trading? I'm trading every day, guys. I'm buying assets every day. I keep telling y'all, there's no greater time. There's no better time in American history to get rich. Some of y'all just don't believe me. And that's okay. Listen, man, I'm just one guy on YouTube. You ain't got to believe me. I'm telling you what I'm doing. I'm buying every day. Every day the market open, I'm buying. And one of my 3 strategies. I got 3 strategies to buy paper assets. 3 of them. And through those 3 strategies, I'm in the market every day that it's open. Like I said, as soon as I get off this call, I will be buying some SPLG and FTEC. I'll be buying it, $100 to $300 worth. Every month, I'm dollar cost averaging a good chunk of money every month, dollar cost averaging. Every month, 50, 30, 20. That's my wealth transfer blueprint strategy, 50, 30, 20. Why are you doing that? In the market crashing, I wanted to crash because I can buy them cheaper. I wanted to do the same thing it did in 2022. So you got to understand, guys, I don't worry about the market crashing because my exit strategy is 10 years from now. See, a lot of y'all got an exit strategy. Oh, I don't want it to crash. My exit strategy tomorrow. Or that's fine. That's not my exit strategy. My exit strategy is to buy these assets as cheap as possible for the next 9.5 years. And in the last part of that 10th year, I want them to go to the moon. Now, I think they'll go to the moon every year, though, because I think over time, everything that I'm buying will increase in value. That's what I think. Because see, here's my ace I have up my sleeve, interest rates. See, interest rates is the ace that I have up my sleeve that nobody at the card table sees. That's the ace up my sleeve. And I know once those rates come down, I don't know when it's going to be. But when they do, hallelujah, the assets going through the roof. Because when rates come down, assets go up. I don't care where in history you go look, that's the case. Rates come down, assets go up. Why? More demand. When people can borrow money cheap, they buy assets. So it creates more demand. See, that's the ace up my sleeve. Nobody at the table sees this ace up my sleeve, but that's the ace. And I know that because I got 30 years worth of experience doing this. Got 30 years of doing this. So I know the best time to buy assets, double down on assets when interest rates are high. That's the best time. Why? Because you always know when interest rates go down, it introduces a new supply of money to the marketplace. People take that new supply of money and they go to town, which drives up demand, which drives up asset prices. That's where I make my net worth. So that's my first 2 strategies. DCA every month, certain dollar amount, never changes. I do it every month, same day of the month. And I'll do that for the next 10 years. That's my DCA. Second strategy, I buy $100 to $300, 2 ETFs every day the market is open, $100 to $300. Well, Richard, why are you buying $100 to $300? What's the significance of that? Well, that's the number that I picked. I just decided, hey, if I can average $200 a day, you got 200 trading days, that's $40,000 a year. I just do that for the next 10 years at an 8% compounded rate of return. I don't know, that's about $650,000, $700,000 in the old pot of gold at the end of the rainbow. Doing $100 to $300 a day. That's gonna drive about $650,000 to $700,000 worth of net worth gain just on the second strategy. The first strategy is gonna be crazy because I'm putting a bunch of money in every month. Way more than way more than the $40,000 a year. So that's gonna be crazy on the first strategy, right? But that's DCA. Second strategy, about $40,000 a year through 2 ETFs. Third strategy is where I do a short-term strategy where I take money on that I got on the sideline and I buy NVIDIA or I buy Tesla. Right now, those are really the only 2 I'm buying with the short-term strategy. I've already told you what my catalyst is for NVIDIA. They got an earnings call coming, an earnings report coming on May 22nd. I'm a strike before that. I'm a strike before that because I think the stock price goes to $1,100 per share once they hit their 4th straight quarter of beating expectations on earnings, which I think they will. I think they'll beat it. And when they beat it, I think it goes to $1,100 a share. I'm already be positioned though. So that's a short-term strategy that I'm using. And I think it will work. And if it don't, oh well, I just hold NVIDIA till it does work. I mean, I think it'll work at some point, right? I'm not gonna panic and, oh golly, I missed it. Sell it off for a loss. No, just put it in, just boop, put it to the side and forget about it until it corrects itself, which it will eventually. So it's not gonna be the end of the world. But man, if I hit it right, we're gonna make a lot of money. That's if I hit it right. And I think I will. I think I will, by the way. I think I will hit it right. I think I will hit it right. Let's talk about what's going on today in the stock market a little bit deeper. I know I just mentioned it, but let's talk about these paper assets a little bit deeper so that we can see if we got any golden eggs that we can find. You know, let's go on a golden egg hunt. Let's see if we got any opportunity in today's stock market that we can execute on. I like to do this on a daily basis to give you little tidbits that you can potentially execute on and you know, find you one of these golden Easter eggs, right? Let's take a look here. Here's the headline. Stocks tick higher after latest US inflation data. They're talking about the PPI report, right? So here it is. Stocks traded higher on Tuesday as traders looked for clarity on future Federal Reserve policy moves after April's producer price index rose more than expected. So investors are out here thinking, what is going on here? What's the play? What's the play? That's what investors are saying. The Dow gained 105 points. The S&P added 0.2%, while the NASDAQ also increased by 0.2%. The producer price index reading for April came in above estimates, putting a damper on expectations that the Federal Reserve would be cutting rates later this year as inflation weakens, right? Bond yields ticked higher. Market moves were contained as the March wholesale prices reading was revised down to show 0.1 decline, easing some of the inflation concerns. Traders may also be hesitant to overreact to this report ahead of the more closely followed consumer price index due to be released Wednesday. I just told y'all that 5 minutes ago. So these investors ain't stupid, right? They said, okay, wholesale prices came out a little crazy, but that's okay. That ain't the big boy. Let's wait for the big boy. That's the CPI inflation report for April. Let's wait for the big boy. That'll be out tomorrow. Now, if that thing goes sideways, I think you will see a sell-off in the market. That's my opinion. Doesn't mean it's true. I'm just telling you what my opinion is. The Dow is coming off its first losing session in 9, snapping its longest winning streak since December. The S&P also inched lower, while the NASDAQ rose slightly. A report from the New York Federal Reserve showed that consumer expectations for inflation over the short and long term grew in April, putting pressure on stocks. So as consumers start feeling discouraged by inflation, what does it do? It decreases demand for assets, so assets do what? They come down in value. That's basically what it is. People are batting down the hatches. Oh golly, let me batten down the hatches. I can't do it. Nope, let me batten down. People are not interested in buying assets. People are interested in surviving. People ain't interested in pot of gold at the end of the rainbow. They're interested in surviving. So reduction in demand, right? That's what people are telling the Fed. The Fed are asking the people, what do you think about inflation? Oh, I think it's going to be higher for longer. That's what people are saying. So what do people do when they get afraid? They don't look for opportunity when they get afraid. They look to go protect themselves. So guess what? I ain't thinking about opportunity. I'm thinking about protecting myself. That's where the 1% want you. They want you in that state of mind. Yeah, that's where they want you. They want you scared to death, afraid, confused, on the sideline. That's where they go get all the goodies. They go get all the goodies. They want you afraid and scared and, inflation is gonna, So therefore, you ain't thinking about building wealth. The only thing you're thinking about is surviving. What they doing is getting all the goodies. Gobbling up all the goodies. That's what they're doing. I'm just telling you. You got to change your mindset, people. You got to change your mindset. If you're going to build wealth, you got to change your mindset. You have to. You have to. So let's take a look at some opportunities. Let's take a look at some opportunities. Stocks moving before the bell. So before the bell, 9:30 this morning, here's some stocks that are killing it. Some are killing it, some aren't killing it. But here's one maybe y'all haven't paid any attention to, but it looks like it's starting to jump a little bit. Meme stocks. GameStop jumped 119%, adding to Monday's gain of 74.4% after the man who fueled the 2021 GameStop frenzy, Roaring Kitty, posted online for the first time in about 3 years. AMC soared 105%, while Reddit and Robinhood rose 4.6% and nearly 7% respectively. Alibaba, U.S. listed shares dropped 4% after the Chinese e-commerce retailer reported an 86% drop in profits for its fiscal fourth quarter. However, Alibaba beat revenue expectations. Sony, the PlayStation maker, U.S. listed shares added 3.5 after posting quarterly revenue of 3.5 trillion yen, dropping the LSEG consensus estimate of 2.89 trillion yen. So you got some opportunity out there, a couple meme stocks from our past, right? GameStop, AMC. Just depends on what you want to do. Just depends on what you want to do, guys. There's a lot of opportunity out there, a lot of opportunity. Home Depot earnings topped Wall Street's estimates for the 16th quarter in a row. But despite that, earnings per share fell 5% from a year ago, the fifth straight quarter of year-over-year declines. That also comes after earnings fell more than 6% in the year-ago quarter, with earnings down 11%. Is Home Depot an opportunity? Is it an opportunity? It's one of the big boys. Is that an opportunity for us? I don't know. Y'all got to check that out. Do a little bit of homework. Right now it's trading at $339.23. But is it an opportunity? I think it is. I think it's an opportunity, right? Definitely an opportunity that you want to put on the short list and do a little research. It's one of the great companies. It's one of the great S&P 500 companies, guys. It's one of the great companies. So think about it. Take a look at it. See what you think. Can it rebound? Right now it's on sale. And I know some of y'all are saying $336 a share ain't on sale. It's on sale, guys. It's on sale. It's on sale. So think about that. See if that's an opportunity for you or not. I think it could potentially be an opportunity. It could potentially be. Now, again, you're getting it through the S&P 500, so you ain't got to do too much. But it might be an opportunity. Might be an opportunity for somebody out there. Let's take a look at, see what's going on with my favorite individual stock. Let's see what's going on with NVIDIA. That's my favorite individual stock right now that I'm going to continue to make a lot of money on. I'm going to make a lot of money on NVIDIA over this next couple of years. I'm going to make a lot of money on NVIDIA. Right now, my favorite stock is trading at $907.54. 3 weeks ago, it was trading at $767. 3 weeks ago. 3 weeks ago this Friday, it was trading at $767. So it jumped all the way up to $907.64. It's up $3.65 today. Is that still an opportunity? I think it is. I think it goes to $1,100 a share if they beat expectations in this Q1 fiscal year earnings report. I think they do. So that's where we're at on NVIDIA. Y'all know that's one of my favorite companies right now to just make money in. To make money in. One of my favorite ways to make money. Let's talk a little bit about the housing market. What's going on? Here's the headline. Housing has hit rock bottom. Top real estate CEO says high income prices are shuttering people out of the market. I've been told y'all that. But he's talking about middle class and lower middle class earners. He ain't talking about the 1%. The 1% can pay cash, or they can absorb a 7.5% mortgage rate. Get me a good price, negotiate me a good price. I'll hold that mortgage rate for a couple of years. They'll come down, I'll refinance. That's what a lot of them are doing. That's what a lot of them are doing. So yeah, it's gonna be tricky over these next couple of years. You're gonna have people who understand the opportunity to make wealth, and then you're gonna have people that are afraid. They don't understand the opportunity. They're just afraid. They're just afraid that the whole thing is gonna cave in on them, right? And I'm here to tell you, you gotta pick a side. You gotta pick a side, guys. You gotta pick a side. Housing is complicated, but one thing is clear. It's hard to buy a home right now. No duh, very hard for the middle class and the lower middle class. Earners, let me paint a picture for you. Home prices skyrocketed during the pandemic-fueled housing boom. Correct. He's correct. More people were working from home and could do so from anywhere. Plus, mortgage rates were historically low. Ding, 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 plus, right? Both of those things are correct. But then inflation rose and the Federal Reserve raised interest rates in an attempt to tame it. Mortgage rates followed. That's what I keep telling y'all. Mortgage rates are going to follow short-term rates. They are. Short-term rates go down, long-term rates go down. At some point, they trail, but they go down. Short-term rates go up, mortgage rates go up, right? We know this, or at least we should know this. Mortgage rates followed, but unlike in typical housing cycles, home prices didn't fall, right? Home prices didn't fall. Rates go up, but home prices don't fall. You would think when rates go up, you got less demand because people can't afford it. But why would prices stay up? Okay. Well, we'll get to the answer here. Why do prices stay up when rates go up? Prices should fall, right? So what do we have? High home prices, high mortgage rates, and depressed home sales. It's a three-headed dragon. That's a three-headed dragon. High mortgage rates, high home prices, no sales. That's a three-headed dragon, man. That's a three-headed dragon in the housing market, right? And it's even harder to buy a home if you're never owned one before, meaning mostly younger generations are being hit the hardest. The issue is that the correction hasn't been a correction. Prices are up 5%, said Redfin's chief executive. And that's because interest rates rose so fast this time, and there hasn't been a recession. He continued, so the soft landing has been good for America overall. Good, obviously, for the economy, but it's been bad for the housing market because it keeps rates high. And so that's why there isn't more inventory reaching the market. And that's why homes haven't become more affordable. Normally in a market like 2008, you see prices come down 30% to 50%. And suddenly buyers are back in the game. But this time, prices are still really high. And especially first-time home buyers are shut out. Millennials have been waiting a long time to buy a house, and they just can't get a break. So your younger folks can't get a break. Can't get into house or home ownership. Rates are too high. Prices are too high. Can't get in. But baby boomers, we've watched their home values soar. And anyone who bought before or during the pandemic, I tell y'all that all the time, anybody that bought before or during the pandemic are generally doing all right, aside from maybe feeling stuck because they don't want to lose their low mortgage rates. Housing has hit a rock bottom. 4 million people are going to move this year. 4 million people. That is the lowest number that we've seen in many, many years. And it's just because interest rates have been so persistently high. Guess what the number was in 2019? Was it 2020 or 2019? It might have been 2021. I think 2021, 6 million. 6 million. Now we're down to 4 million. 6 million homes sold. I think it was in 2021. Don't hold me to that, but I think I'm right there. In 2021, I believe 6 million homes were sold. We're down to 4 million now. 2 million drop. You think that ain't impacting somebody's pocketbook? What about those people in the housing market that depend on transactions to live, to make a living? How do you think they're feeling right now? You think they're in that 1%? You think they're up in this good old economy? They're not. Housing market is hurting. The people who work in the housing market are hurting. Real estate agents, mortgage brokers, title companies, real estate attorneys. Anybody connected and make their living through the housing market are hurting. The only people who ain't hurting are investors who got big pockets, who can afford the mortgage payments. They are doing great because they can go into that market and pick and choose what they want and get good deals on it. So, hey, this economy needs the housing market to do better long-term if we're going to make it, right? We got to get the housing market going. Only way we get the housing market going, guys, is we got to get inflation down so the Fed can reduce short-term interest rates. And then long-term interest rates will drop. That's how we get it going. Right? Anybody that's connected to that housing market, I don't care if they make their living off of that housing market, with the exception of investors, they hurting right now, man. You go from 6 million transactions, homes sold, to 4. Somebody hurting out there. Somebody out there is hurting right now. 4 million people are going to move. That's the lowest number that we've seen in many, many years. And it's just because interest rates have been so persistently high. And it's going to stay that way until we get inflation down. But it could be better than last year when existing home sales fell to their lowest point in almost 30 years. That was 23. Kilman thinks some people are less likely to put off their home buying plans this year just because they're going crazy living with their ex-wife or they have a third baby and there's no space in the house. But still, the overall economic conditions for buying a house are rough. Not for investors. Not for investors, it's not rough. Now, it's rough for you people who want to go buy these houses and just sit them and it be a dead asset. It's rough for you. But for investors, it's not rough. It's a smorgasbord. If you're an investor and you know what you're doing. If you know what you're doing and you're an investor, you should be crushing it right now. You should be buying up rental properties like crazy. In a separate interview with CNBC on Wednesday, Realtor.com's chief economist Danielle Hale said there are 36% fewer homes for sale now than before the pandemic. 36% less than before the pandemic. And with high home prices and high mortgage rates, buyers need to earn more than $100,000 in 34 out of the 50 largest metropolitan areas to buy a typical home. And guess what the average family in America makes? $75K. If you're African-American family, you make about $50K. They're saying you need to at least make $100K in 34 out of the 50 largest metropolitan areas to even buy a house. I mean, so 34 out of the 50 largest areas in our country, you got basically nobody can buy a house. I didn't come up with these statistics. I'm just reading them. 100,000. With high home prices, high mortgage rates, buyers need to earn more than $100K in 34 out of the 50 largest metropolitan areas to buy a typical home. Wow. Unfortunately, $75K is the average salary for a family in the United States. So that just goes to show you guys, not many people in the middle class, lower middle class, like we started this conversation with, all of this stuff is about the middle class and the lower middle class. It has nothing to do with the 1%. They're thriving. That's why it's so important, guys. You got to start buying assets. You got to start building your wealth. You got to start executing and building your wealth. The only thing separates you and the 1% buy assets that create income. We buy liabilities that create debt. That's the difference. They buy assets that increase in value, build wealth, generate income. We buy liabilities that create debt and keep us broke. That's the mentality we got to change. That's the mentality we got to change. And here's the thing. There is a bit of bifurcation. Places such as Florida and Texas, as Kilman pointed out, are seeing home prices ease because they're building homes. And he expects that to continue in red states where it's typically easier to develop anything. That's true. That is so true here in Florida because it's red as an apple. In California and New York, there simply aren't enough homes for sale to see prices fall meaningfully, if at all. So that's why in cities in California where you need to make more than $100K to afford a home, younger generations are renting. It's why we see home ownership rates in these large markets trail behind typical U.S. housing market, Hale said. So it is challenging. Despite some improvement in for sale inventory compared to last year, She said it's still a pretty dire situation for young people. See, young people typically don't have the wealth. Typically, the people who have the wealth are the older people, which AKA baby boomers. These younger generation don't have any wealth. But most of them don't. Why? Because that's not something that was important to them. Now, all of a sudden, we get trapped in this situation here. It's important. That's why I keep telling you guys, we gotta build wealth. We gotta execute. We gotta turn this thing around and do what we need to do in order to get to where we need to be in order to protect ourselves, where we can become recession proof. We gotta become recession proof like the 1%. So this is a great opportunity. As these assets decrease in value temporarily, they will decrease in value temporarily. Our job is to buy as many of them as we can as they increase in value temporarily. So what will happen is as interest rates go down, you will start seeing the pendulum swing back on investments will be going down, 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 down in value, and then all of a sudden they will smooth out and start coming back up as interest rates fall. That's what'll happen. But until they fall, this is a great opportunity for us to do what? Sacrifice something up front, pay the price today. Let's sell all this stuff that we don't need. Let's create a bunch of cash, and then let's take that cash and let's put it in assets. I challenge anybody out there who is not where they want to be financially. I challenge you to take an inventory of all the stuff that you own. I challenge you to get rid of the things that are not vital to life. Turn them into cash. If they're not vital to life, sell them, turn them into cash. 3 things you do with the cash that you get from that purge. I like to call it a financial purge of stuff that I don't need. So the 3 things you want to do when you purge. Number 1, I want to put my emergency fund in place. So let's say Richard Fain has $20,000 worth of crap. I got $20,000 worth of crap that's not vital to life. Oh, I got a Rolex watch. I got an Omega watch. Okay, maybe I got a couple Louis Vuitton handbags. I don't know, maybe I got a jet ski. Oh, maybe I got just a lot of toys. I don't really use them no more. I don't really they just there so I can look at them and feel good about myself. Oh, golly, Richard, you're doing so well. Look at all the stuff that you have. God, you're doing well. But when I really sit down and look in the mirror and say, Richard, not really. Your net worth ain't where it needs to be. You're living paycheck to paycheck. You don't have an emergency fund. You got some credit card debt. See, now I start to say to myself, maybe I'm not looking as good. So now, Richard, I tell myself that today is today. I'm going to purge, and I'm going to go ahead and take my cash, and I'm going to do 3 things with it. Number 1, I got to get my emergency fund together. So as I sail through that crap that I don't need, that's not essential, the Rolex, the jet skis, the 10 pair of Michael Jordan sneakers, all that crap that ain't essential to me living, once I get rid of all of it, I create cash. Now I take that cash and I put 3 to 6 month emergency fund together. Second thing I do with that cash is I try to pay off any high interest rate credit card debt. I don't worry about my student loan that's at 3.5% that I got on a 10, 15, 20-year amortization. I don't worry about that. What I worry about is high interest rate credit card debt, or high interest rate personal loan debt, or high interest rate car loan debt. Those are the things that are number 2 on the list. Number 1 on the list is the emergency fund. Number 2 on the list is any of that high interest rate credit card debt. Number 3 on the list is I start investing to build wealth. So that's what I do with the money from the purge. I purge all of this crap that I don't need, guys. Yeah, I got to stop identifying my worth and my success with things. A lot of us identify our worth and our success with how many things we have. That's ridiculous. I get it because that's what we've been taught since we were kids, straight out of the womb. That's what they've taught us. Richard, listen, you're successful if you got this kind of car. Richard, you're successful if you live in this kind of house in this neighborhood. Richard, you're absolutely successful if you wear the designer clothes or if you, whatever it is. That's what has been given to us. That's how, but that's the trap. That's the trap of the 1%. They want us focused on the exterior, how good we look, how many things we have. Therefore, we're not focused on what's really important, which are assets that create income so that we can own 100% of our time, right? That's what they don't want us to focus on. So if I were you guys, that's what I'd be doing today. I would be making me a purge list. I would get me a piece of paper and a pencil or get my phone or whatever you want to do. And I would start listing all of this stuff that has some value that I don't need anymore. So someone comes to me and says, hey, Richard, I got any money. I want to invest. I want to build wealth, but man, I'm stuck. I ain't got no money. First thing I ask them, well, give me put a list together, all the things that you have in your house, in your attic, in your garage, in your basement, in your closets, in your storage unit that may be valuable. What do you mean? Yeah, you need to sell all that stuff. You did say you want to get yourself right financially, right? By any means necessary, right? Didn't sell all that stuff. That's not going to take care of you. That's not going to generate no income on a monthly basis for you. Why do you have it? Sell it all. Take the money and do these 3 things I just told you to consider. That's up to you though. See, you got to be radical, guys. You got to be willing to change something in your life if you really want to change. See, a lot of us don't want to change. We want to talk about change, but we don't want to change. We just want to talk about it. I just want to feel good that I talked about it. I'm not really ready to give up the Rolex just yet. I'm not willing to give up the beauty salon once a week. I'm not really ready to give up the pedicure and the manicure. I'm not ready to give up my annual trip to Jamaica. I owe myself that. See, we ain't really hit the fence or hit the wall yet financially because we won't give up any of that stuff. Although we really know that stuff is not vital or instrumental or needed to live. That's why we find ourselves down here in the middle class, the lower middle class, struggling and holding on to stuff that we shouldn't be holding on to. I don't know, man. I would just say, think about that. Daily mortgage rates have fallen after a recent run-up over the last few weeks. The current average 30-year fixed rate mortgage rate is 7.18%. Super duper high. Where mortgage rates are headed really depends on the economic conditions, particularly inflation. We just talked about that. I told you, interest rates are predicated on what inflation does, right? Which is proving to be stickier than expected. And inflation has been so stubborn, for one, because of housing. It's large component of the consumer price index. We've seen the housing component soften a bit, but not enough to bring rates down. And he isn't keen on predicting where mortgage rates will end up this year. I'm just trying not to count my chickens before they hatch. We've had our hearts broken before. That's so true. Where we thought we might get lower rates later in the year, Redfin isn't betting on that right now. For Hall's part, she said, I don't think we're going to see inflation eventually relent and mortgage rates come down. And we'll have to wait until May 15 to see where inflation lands, and even longer for how the Fed will react. That's coming from your daily dose of your housing market. That's the daily dose of your housing market, guys. We can look at it 2 ways. We can look at it as, oh, golly, everything's falling in. It's terrible. It's horrible. Or we can look at it as investors and say, whoa, this might be an opportunity for me to go grab me a couple assets. But in order to grab those couple of assets, you're going to have to do what? Decent credit, verifiable income, down payment money. You're going to need that. You're going to need that. We was in my my private live stream yesterday with my mentorship club, and one of the gentlemen sent a message, and he was saying he was trying to buy a property. They had approved him, and a couple things changed. The appraisal came back short, blah, 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 blah. And he started basically saying the bank is starting to give him the runaround. Now, nitpicking him. Oh, yeah, we know we got you approved, but we got to give me this, give me that. Prove to me where that money came from in that account on that date. Just starting to get nitpicky on it. And I said, hey, don't be surprised. That's what they're going to do now. These banks are not stupid. They're starting to tighten the screws from who they lend money to, because they understand inflation is going to be here for a minute. They understand rates are higher for longer. And who suffers? Middle class, lower middle class. So when you walk in there, oh yeah, I make $75,000 a year. I want to buy this house. I want to do all of this. You think they're looking at you like, oh my God, this guy don't have no assets. He ain't got no fallback on. Yep, he got decent credit. Yep, he got a little down payment money. Yep, he got verifiable income, but he got no other assets. What if he hit a wall, a financial wall? Do we get repaid? And a lot of these companies are saying, we want to see some assets. We want to see more than the down payment. We want to see some get me out of trouble money. No longer are they going to let you just walk in there and, oh, yeah, I got a 720 credit score. Been on my job 3 years. Here's my tax return. Yes, I barely got the down payment money, but I got it. Here it is. They're not going to take that no more. They want to see some extra. They want to see some get out of trouble money. That's why you got to have assets. See, it'd be a different story. You walk in there, decent credit, verifiable income, down payment money. But guess what? I got another $250K over here in investments. That's my get out of trouble money. That's going to make that lender feel a little bit better. Oh, shoot, Richard, great. You got decent credit, you qualified there. Income's good, you qualify there. Down payment, no problem. Oh, it's also nice that you got a good net worth. And a lot of it's in cash and marketable securities, so it's easily converted to cash. We like that. Yeah, I think we can help you. That's the way it is, guys. These banks are not in business to make money to people that can't pay them back. That's life. That's why I keep telling you, you better get you some assets. You better get you a cushion. You better have you some get out of trouble money. That's what you got to do. That's what you got to do. And I've already told you where I would start. Purge. Purge it all. Purge it all. I would purge every bit of it so that I can put myself in a position I can start investing and buying these assets. No greater time than right now to do that. Let's see what crypto's doing. I haven't had a daily dose of crypto in a minute. Let's see what our favorite cryptocurrency is doing. Bitcoin. $61,712, down almost $1,300 today. Again, guys, all assets go down when interest rates are up, especially when there is no FOMO, especially when there is no optimism. Right now, you don't have any optimism and you don't have any FOMO to prop up assets right now. So what does it do? It reverts back to what it should do. Interest rates up, assets down. Unless you got FOMO, unless you got optimism, and you don't have that right now. Now, we can look at that as a bad thing, or we can look at that as an opportunity to build wealth, right? So let's look at what the markets are doing. Dow in the red. But that S&P, man, is over 52.23, which is pretty dang on good. NASDAQ in the green, 16,427, currently in the green. The only one in the red right now is the Dow. That's the only thing in the red right now. Is there an opportunity here? I think so. I think so. I think there's an opportunity because, see, I believe these great assets that I'm buying right now, guys, I still believe they're on sale. And I know some people will say they're on all-time highs. All-time highs will be broken, man. They will be shattered. I think the S&P is 5,500 points by the end of the year, especially if the Fed reduces once or twice. S&P will be 5,500. It's currently 52. There's some upside right there for somebody that's willing to take a chance. I don't know who that is, but that's some upside. There's some upside. Plenty of upside for somebody who decides they want to take a chance. They want to understand an opportunity that is right there pointing them square in the eye. Just looking right at you. So what should you be doing? What should you be doing? How should you be positioning yourself over these next several weeks? How should you be positioning yourself? Well, let me put it this way. This is how I'm positioning myself. And if you want to rock with that, rock with it. If you don't, you don't. You know, it's up to you. You got your own plan. Do your own plan. I'm not here to try to tell you what to do. I'm just here to tell you what I'm doing. So here's my positioning over the next several weeks. Matter of fact, this is my positioning until the next Fed meeting, which I believe is in June. Let me see. Next Fed meeting. Yeah, FOMC will be held in June. All right. Can you give me the date? Okay. Can you give me the date? I get it. It's in June, but can you give me the date? Can you give me the date? Okay, there you go. So June 11th and 12th. That's our next Fed meeting. June 11th and 12th is the next Fed meeting. So that gives me what? 2 months? No, 1 month. Yeah, 1 month. Gives me 1 month. So what should I be doing? What am I going to be doing in this next month? Well, number one, I'm going to be looking at the data that's coming out. So tomorrow, I've already got the PPI. Well, let's go back. I've already got the jobs report. That was a good one because it came in weaker than expected. So that's a good one for decreasing rates because it came in weaker than expected. PCE report came out hotter than expected. So that's not good for rates going down. So you got 1 and 1. You got the jobs report weaker than expected. That is a plus for bringing rates down. The PCE report came in hotter than expected. So that's a negative for bringing rates down. PPI report came in a little hotter than expected. That's a negative for bringing rates down. Let's see what the CPI report for April says, because that's important, right? That's important. And then we'll get May's jobs report before the Fed meet. And I believe we may even get May's CPI and PPI report and PCE report, hopefully, before the June 11 and 12 meeting by the Fed. So it's a lot of data. So that's what I'll be watching. A lot of people ask me, well, Richard, what do you be looking at? That's what I look at. Now, I'm not sitting here reading the report, the whole dang on report, the whole 100-page report. That's not what I'm reading. I'm looking at the headlines. I'm looking at the cliff notes. All I need is the cliff notes. I don't need to be reading no 25, 30, 50, 70, 80 pages of stuff I don't even understand. I just need the cliff notes. So I look at the cliff notes of all those reports, and then I say to myself, what a great opportunity. Well, how do you know it's a great opportunity? You don't know if it's bad or good. It doesn't matter. Bad or good, it's a great opportunity to build wealth, right? If it's good news, and I think, FOMO comes back to the market, my assets that are already in the market, what do? They go up in value. See, it's not bad news for me either way, guys, because I'm in the market 365 days a year. If you're in the market 365 days a year, any news is to your advantage. If it's good news, and I think, and FOMO comes back, and FOMO runs the value of my stocks and my ETFs higher, I win. Why? Because I've been buying them for less all of this time. They're worth more now. If bad news happens, let's say CPI come out tomorrow and it's a miss. Let's say May's jobs report come out, it's a miss. Let's say May's PPI, CPI come out, it's a miss, and things just tumble. That's not bad for me, because now I can take my money and buy these assets cheaper. And I just hold them. Remember, I got a 10-year window here. I ain't worried about tomorrow. I ain't worried about next month. I ain't worried about 2 years from now. I'm worried about 10 years from now. My research tells me no matter what happens in the short term, everything I'm buying today will be worth more in 10 years than it is now, regardless what happens in this little short term. History tells me there's never been a 10-year block in the S&P 500 where it's traded at a negative. That's history over 100 years. I'm going with history. I'm not sure what you're going to go with, but I'm going with history. So for me, it's all about buying. It's all about putting myself in a financial position where I can continue buying every single day. That's all it's about for me. Putting myself in a financial position where I can just buy. This is what I try to tell my people in the mentorship group on my website. You know, guys, just focus on earning your income and buying. Don't worry about selling right now. We sell later down the road. Don't worry about selling. All you worry about is make a 10-year commitment to buy. Well, Richard, I only want to make a 5-year commitment. Then make a 5-year commitment. It's your plan, not mine. I know what my plan is. I ain't changing it for nobody. If your plan is 5 years, do it for 5 years. It's your plan. But goodness gracious, have a plan and stick to it. Execute it. Don't be wishy-washy. Make a decision. Have some discernment. Be decisive. Stop being so flip-floppy. Lukewarm. Oh, the guy on CNBC said I should wait. He already rich. Of course he gonna tell you to wait. He rich. This billionaire said I should do it this way. He's a billionaire. You're not. That's all I'm saying, guys. We got to stop listening to these people who are already billionaires. Now, I'm not saying all of them are saying stuff wrong, but come on. Dude, you're a billionaire. You ride around on a private jet. What can you tell me about waiting? And come on, man. Come on. This guy don't even live in the real world we live in. These people don't live in the world we live in. So get your plan together. You got a month before the Fed meets. They meet on June 11th and 12th. You got a month to get your plan together and get yourself going. Right? Now, I'm here to help you get yourself down in the description box. Click on the Moomoo link. Open up your brokerage account. Get yourself 10 free fractional shares of the Magnificent 7 stocks when you put $100 in your brokerage account. But that's being decisive. If you're going to build wealth, you got to be decisive, guys. If you don't know what that means, go look it up on a $10 trillion research lab. You got to be decisive. Can't be wishy-washy. Can't be procrastinating. Can't be on the fence. You got to be decisive. If we're going to build wealth, we got to develop a decisive attitude. I'm not saying do something stupid. I'm just saying be decisive. Find a plan that you like and execute. That's being decisive, right? Gotta be decisive. So get down in the description box, click on that Moomoo link, open up your Moomoo account today. Go get that free stock. Go get that free money. It's an offer you just shouldn't pass up, right? If you want 7 fractional shares of the Magnificent Seven for free, bingo. And it's the brokerage app that I'm using for the next 10 years to double my net worth. So if I'm using it and it's good enough for me, I would say potentially it's good enough for you. You make that decision, right? But I'm saying if you want to make the decision, get down in the description box and do it today. Also, get over to the website. Second link down in the description box. Get over to the website. Immerse yourself into those digital products, guys. That's where the rubber meets the road. We're looking for information that gives us step by step, right? Now, step by step doesn't mean you're going to know every single thing you need to know when you purchase the digital product that walks you through how to buy real estate, how to invest in real estate with little to no money down. It's going to give you all the steps, but then you got to execute. You got to execute. So get over to the website, check out those digital products that were handpicked by me, and invest in yourself. You do know an investment in you is the best investment you will ever make, right? That's the best investment you will ever do. You'll get the biggest return on investing in yourself. Because if I can invest in myself and I can get myself to a point where I'm confident, I can trust myself, right? I'm decisive. Guess what? That's all you got to do. So here's the thing, man. We can allow other people to dictate what we do. See, here's how I am. I'm a guy on YouTube, right? And I've been doing this for almost 5 years. And I find it really, really comical how these so-called people who are doing so well, why are you in my channel? I don't know. I mean, if you're doing that well, why are you in my channel? Why are you here in my channel? Create your own channel. I mean, I just find it so comical. It's so obvious that people have no direction in their life. Some people, no direction, none. Got no wealth, but yet and still try to act like they do, but they don't. They don't. Here's the thing, man. I'm smart enough to know what I'm doing, right? I know what my limitations are. I know that I've paid the financial price to be where I'm at. And I know what my mission is. My mission here is to help people that want to be helped. My mission is not to help everybody on YouTube. My mission is simply to help those that want to be helped. That's it. It doesn't matter to me if you don't want my help. All I know is thank you for stopping by the channel. Thank you for commenting. Thank you for helping the algorithm spread the content out to more people. Thank you. That helps my net worth. That helps me build more net worth. So thank you. I appreciate any trolls that stop by and tip their hat, because that's just helping the algorithm. See, the algorithm at YouTube is built on, views and comments. And so I love it. I love it. Thank you so much. I appreciate you helping me increase my net worth. Well, guys, I appreciate y'all, man. I'm going to get on out of here. I got some more stuff to do. I got to get out of here. But, man, it's been wonderful. Hopefully you learned something. Hopefully you grab hold of a couple of these nuggets that I just dropped for you today. And hopefully you'll use those nuggets to help you build your wealth and get to your pot of gold at the end of the rainbow. Hopefully. I enjoy my hour and a half on YouTube every day and get to take the other 22 and a half hours and just do whatever I want to do. So I spend an hour and a half on YouTube, and then I get to spend the other 22 and a half hours doing exactly whatever I want to do. I ain't got to worry about how I'm going to take care of myself. I ain't got to worry about none of that. That's where we want to get to, guys. We want to control 100% of our time. I control 100% of my time. I spend an hour and a half on YouTube, and man, I control 100% of the rest of my day. Who else has that? Where else is that available? That's where you want to get to, guys. You want to build enough assets where you can do that. You could spend 1 hour, 90 minutes on YouTube and do nothing else for the rest of the day. I don't know, man. This is America. This is America. I love it. I love it. I love it. And like I said, I appreciate everybody that stopped by, even the trolls. I love them because they motivate me. They motivate me to be able to continue to spread this financial gospel, because I want more people to control 100% of their time, right? I want more people to be able to have assets so that they have more choices, more freedom, and more time in their life. I want more people to get to the point where they're recession proof. But if you don't have assets and multiple streams of income, guys, you don't get there. You don't get there without assets that generate income and multiple streams of income. You don't get there. So I appreciate it. I appreciate you. I will see you guys here tomorrow, same time, 10:30 a.m. Eastern time. Trolls are welcome. I always welcome the trolls. I welcome everybody. Because for me, it's about the information. And I know everybody won't embrace the information, and that's okay. It's okay. It's okay. I'll survive. Lock it in with a thumbs up before you get out of here. Make sure you lock that thing in with a thumbs up. Even your trolls, even the trolls, lock it in with a thumbs up before you get out of here. Hey, even the trolls can lock it in and let me know they'll be back tomorrow trolling again. Lock it in with a thumbs up, trolls. And everybody else who rock with me, lock it in with a thumbs up. Like I say, I'll see you guys tomorrow. I'll probably be dropping some more edited content this afternoon like I normally do, just to keep the algorithm on its toes, right? I gotta keep that algorithm on its toes. I know exactly how this YouTube game works, so I gotta keep that algorithm on its toes. So I may drop something later this afternoon. Look out for it. Look out for it. Also, guys, hit those links down in the description box. Get that Moo free stock. When you sign up, put $100 in it. Also, get over to the website, patronize the website. Again, guys, you scratch my back, I scratch your back. Y'all know how we rock and roll. So get over to the website, patronize the website, because it's a website I did for you guys. All right. And then also get down to the description box and make sure you click on that Instagram link, that Richard Fane Millionaire Mentor Instagram link. Click on that link, give me a follow, and then send me a DM and say hello. And let me know you're rocking with me. I certainly would appreciate it. Thoughts become things. You can see it in your mind. You can hold it in your hands. You guys keep chasing your greatness. Never stop believing in yourself. Stay healthy. Get wealthy. And I'll catch you guys on the next one. Peace.